guys. Thank you for tuning in for Kate Ventures' first podcast. And for our podcast, we're going to bring you a series of RWA related discussions. So we have a series called the RWA Stacks. And for our first episode, we're going to have our portfolio 3F Labs to join us to discuss how we're bringing carry trade on chain and what kind of problem we're having in DeFi. So first of all, we would love to have Sonya.
Hey everyone, my name is Sonya. I'm one of the co-founders here at 3F. 3F is a leverage protocol that focuses on RWAs. You come to our front end, you choose an RWA that you want to lever up, and you choose your leverage factor. And with one click, the platform is designed to build you this position so that you don't have to manually, recursively loop RWAs, which are especially harder to loop for various different reasons. And we can get into that later.
Yeah, we're very proud to be one of the backers, especially after how we knew how you guys are bringing carry trade on chain and actually make it possible for institutions to finally participate in on-chain DeFi.
Thanks to the support of Gate Ventures and some of our other VCs that have been supportive of our seed round. We announced our seed round, which was $4 million last week. So it was led by Maven 11 with participation from other crypto wing of TradFi related VCs such as F Prime or Susquehanna Crypto. And Gate Ventures, we were also very lucky to have you guys on our cap table.
So before we dive in, I want to let you know for this podcast, we want it to be a very chill chit chat. But when you're being chill, I want you to be real because we're going to have a lot of spicy questions.
Okay.
And I know we started planning this podcast like weeks ago, and in the DeFi world, a lot of things happen in these few weeks. So I want you to be real. How do you think about DeFi right now? Is DeFi dead?
DeFi is not dead. I think we have learned so many lessons from DeFi being experimented on for the last few years. I think we are also learning our bitter lessons about OPSEC, which, for instance, in TradFi is very much expounded upon. But I think this is growing pains. We need to learn these lessons as an industry to become more robust in our infrastructure. And I think that the people with the best lessons that can be implemented in bolstering their infrastructure will win. Unfortunately, some others, who are exploited and don't have the best teams to quickly learn will fade away. But I think this is just our industry's progress for development. And it's not to say that right now the confidence is very low. Even for DeFi users and DeFi founders, I actually have a DeFi founder who says, I'm not touching DeFi with my own savings. I already feel so exposed and so levered to the trends in DeFi. So interestingly, some founders are parking their money off chain in stocks or, non-crypto related assets, which I think is really interesting. So we definitely, the events of last week, I do think it has set our industry back, 6 to 12 months. I think a lot of TradFi money was looking on chain and excited about what was being innovated on. But unfortunately, some will be scared to deploy, their assets on chain, deploy their capital on chain. But I'm very optimistic. Actually, I'm formerly TradFi, so I also know the TradFi industry really well. And I think that there's nothing as exciting and stimulating as DeFi in terms of innovation. And TradFi in many corners are just kind of doing the same thing over and over again. And they're looking at the on-chain world. And actually, some are getting very excited about the speed of innovation and, the talent pool, the average age of DeFi being so young, which means, we have a really healthy runway for growth. All of these things are lacking in TradFi in many corners. And I think these are structural trends that will continue for many, many years to come. But right now, it's just growing pains. In my opinion.
I totally agree with you, right? We do see there are so many things that could be done in DeFi right now. We're just in the process of finding the best way to, first of all, keep the assets safe, which is the most important functionality in the whole financial system. And then second of all, some people are looking for privacy. And then after all these things, we can start exploring how DeFi could do the human nature a good favor and in general. And it is fair enough to say that the current yield does not compensate the kind of exploit risk that users are facing. I still remember like a few days ago on DeFi's podcast, they mentioned even for a DeFi protocol yield with 15%, you would need 5 years to flip it. So for any retail user that is coming to DeFi, it does not make sense to just have your assets sit over there and do the asset management thing, because you need to wait for 5 years and it has to be without exploitation. So that also it kind of explains why currently the DeFi yield is so low right now. And it is inevitable that we need to have RWA so that we can sustain the yield on DeFi. And the good thing is BNY, frankly, Templeton, Fidelity, BlackRock, all of them are bringing RWA on chain. For example, BlackRock's Budo is now collaborating with many ecosystems, right? Including with Securitize and other folks. So with your previous experience working with the financial related industries and working closely with both curators like Steakhouse, other than regulations opening up, what are TradFi institutions seeing in DeFi right now?
Yeah, good question. So for the audience, I don't think we did intros, but I used to work at a company called Steakhouse Financial. They're known as being the largest risk curator on Morpho, and they're curating other vaults using active strategies. So my job there was to grow the Morpho business from inception to now they have, I think, over 2 billion of TVL on the lending side. And through that process, I realized that there's so much capital that does not have access to yield in the world. And I think that's why we're seeing, before the CalpDAO exploit, USDC deposits in Aave were earning as little as 2%. And, the Delphi guys or other people can talk about how the fair risk-adjusted rate on stablecoin deposits has to be 15%. But the reality that we're seeing is there's billions of capital in the world that are happy with 2%. So who are you to argue theoretically that this is, with some assumptions, this is the right cost of capital? I liken that analogy to a joke that was very popular in business school, which was making fun at economists who are always thinking about the most rational thing. And the joke goes, two economists walk down the street. There's $100 bill on the floor. And one of them looks at the $100 bill and says, oh, it can't be, because if there was a $100 bill on the floor, someone would have picked it up anyway. So they don't pick up the $100 bill and just keep walking. So I think it's a little bit naive to my mind to be thinking about what the fair rate is, and not really think about the reality of the world, which is that a lot of, a large proportion of the world doesn't have access to dollar or any stable assets as currencies. And two, even if they had, access to stable currency, like what does a bank pay in your checking account? I was surprised to learn as a recent immigrant to the US that the checking accounts in the US don't pay anything. Even though, treasuries are at like 3.75. So even earning 2% on, platform that may not be as robust as a traditional financial system can be seen as a pretty, good trade-off for many people. That's to say that, I don't subscribe to the view of, DeFi has to have like 15% yields. Having said that, we do currently have low borrow demand, which is cratering yields. I think actually compared to maybe a month ago, we are seeing some recovery in the crypto markets, which naturally excites speculative demand, which in turn increases borrow demand and the rates. So rates have gone up just a little bit. But I wrote a piece on my Twitter, which you can check out later, called RWA-backed lending, the real DeFi 2.0. And in that article, I talk about how the rate of growth for stablecoins has been outpacing the rate of growth of the crypto market cap. So to get into the specifics, the last 6 years, stablecoins grew at around 150% per annum. But crypto has grown at 30% per annum. So stablecoins are growing 5 times the multiple of crypto markets. So if this trend continues, you can maybe even see a world in which stablecoin supply outpaces or is greater on an absolute basis than the crypto market. And in the case of, Aave or Morpho or Euler, we're all operating in this over-collateralized world, right? So right now, much of the collateral is Bitcoin, Ethereum, and their derivatives. If there's too much stablecoin per unit of crypto, then how are we going to generate yield for those stablecoin depositors? And my answer, or I argue in this article, that we have to use different collateral like RWAs. So this is where we are focused on the Morpho side of things. We've launched a 3F Steakhouse Vault, which enables RWA collateral. And our first collateral is Centrifuge JAAA CLO fund, which yields around 4.5% natively. And currently our, borrow rate against that collateral is around 3.3%. So we think that, with the backing of these yielding real world assets, that we will maybe see less cyclicality in lending rates because there's always going to be someone wanting to borrow against real world asset collateral. And in the 3F's case, is specifically the leverage carry traders.
I really agree with you that it is very meaningful for DeFi to bring RWA to get rid of that cyclical nature of yield. Because in the past, we have seen that during the bull market, the yields go so high because of the potential tokens that is printing out of thin air, right? And during the bear market, which is now, the average yield on Aave or Morpho in the past months has been somewhere around 2 to 4%. It's worse than T-bill. So it is inevitable for users to turn themselves to either RWA-backed asset or just take their money off chain. So I think what you're doing here is definitely saving a lot of T-bill in crypto. And I think a lot of people would be very curious about what's the actual meaningful liquidity size we have in DeFi lending now. When you say the stablecoin growth has been outpacing DeFi lending growth.
Yeah, so if my numbers aren't completely outdated, I think stablecoins right now are over 300 billion in circulation, and crypto market is like between 2 and 2.5 trillion. So around, say 15% of the crypto market is in stablecoin supply. I think that will over time change. Right now, the borrow demand on lending protocols is around, let's say 30 billion. So we're still, orders of magnitude smaller than the stablecoin market as well as the crypto market in on-chain borrow demand. If you think about the on-chain borrow demand being a function right now of the crypto market size, if we bring RWAs, which are in the hundreds of trillions, then I think that the borrow demand on-chain will scale with the RWA collateral that we'll see that's coming on-chain. We think the largest use case, at least right now, for on-chain capital for RWAs is leverage looping. It's because, if you can buy 4.5% JAAA CLO off-chain, what makes you think that, 4.5% on chain would be very attractive? This is, for US specific buyers. So you need a reason to buy, RWA on chain. And I think this is what the lesson that tokenization agents and asset issuers are learning is just because you're issuing this asset on chain doesn't mean you can create demand for this product. Of course, that changes very quickly if you have leverage. So if you can put some turns of leverage on this JAAA asset, then you can turn that single digit yield to double digit yield, and that instantly becomes much more attractive to on-chain capital. So what do people borrow for? I think is like the most basic question. that we should address if we were to think about how do we grow this thing. Historically, on chain, people would borrow against their Bitcoin or ETH if they were early believers in crypto and came into a lot of money, but needed, stable coins for everyday usage, like buying a house or buying a car. So you see some of the early whales or OGs saying, oh, I bought my, I put the deposit down on my house, like through over collateralized borrow on Aave, and so on and so forth. And then, then the traders came on chain and they wanted to borrow to make more money, or they wanted to leverage their crypto to make more investments. And I think we saw a huge demand from these, traders who were farming a lot of the token incentives. So if your token incentive is way greater than the borrow cost against your crypto, of course you're going to do this. I would say it was like the second phase, which I think for the large part has frittered away because now there are no more token incentives. There's less farming opportunities in the bear market. And then the third, which I think was really interesting, I saw this integrations while I was at Steakhouse working with the Morpho and the Steakhouse team, is the DeFi mullet thesis. So Coinbase was, I think, the first centralized exchange to allow people with crypto on their exchange platform to borrow against that through Morpho. So I would classify this as like organic borrow demand. People want to, maybe similar to the DeFi OGs, wanted to, buy a house or buy a car. You have some cash for, I don't know, like kids' tuition, but it was just a lot more accessible because the crypto could sit in the Coinbase environment rather than, you having to come to the Morpho front end and deposit your collateral to borrow. That's kind of the natural progression in the short history of DeFi where the borrow demand has come from. With 3F, we're kind of taking it a step further. We're saying, hey, in the real world, hedge funds want to borrow to basically conduct this leverage carry trade. So if you have an asset that earns, let's say, X%, and then you have a borrow cost against that asset that's, at X minus 2%. So you've got a 2% spread between these two opportunities. Then you can amplify that return through leverage and make it into juicier returns. And that's the core of what leverage carry is about. So when I was at Steakhouse, we already saw a lot of people doing this through our vaults, where you pledge collateral, you borrow against it, you buy more of the collateral, which is higher yielding, you pledge against it, borrow, and so on and so forth. And this worked really well for atomic assets, which are instant mint and redemption, but it started working very not well for RWAs that are, that have delayed settlement. So when you buy an RWA, typically you're operating in the traditional world with settlement delays. So for a fixed income fund, it can take you like 1 or 2 days for the transaction to settle and for you to get your shares in that fund. So that doesn't necessarily change when you bring the TradFi asset on chain. The system still has to settle using the traditional backend. So the settlement delays can compound with each loop. Let's say you're doing 20 loops to get up to 5x leverage. That means you have to wait 20 days for the asset to settle, to get in and to get out of your trade. So that's no bueno, right? Who wants to wait 20 days to set up a trade? Definitely not crypto. Maybe in TradFi, but definitely not in crypto. So my co-founder Romy and I started looking for a solution to be able to allow users, both institutional and any sort of like retail users of DeFi, to be able to get access to this leverage carry trade much easier without the problem of looping.
Yeah, that's actually the key reason why we invested in 3F. To be honest, carry trade has always been there on Wall Street. But for institutions to do that in the DeFi world, as you mentioned in the past, you need to do many loops, and it compounds the time. And first of all, it's a lot of steps. And second of all, you need to make sure you need to wait for the liquidity to arrive. So you need to wait for the settlement. You need to wait for the liquidity. It's going to create more risks upon that. And third of all, if I'm an institution, I will not like the idea of my borrowing rate will keep fluctuating. So I believe that's also why you're doing this on Morpho. So before we dive in deeper into your product side, I would also like to ask you the question, why Morpho? I believe this has been a very popular topic recently, especially after what happened to Aave. So yeah, Sonia, why Morpho, and how could institution capital get the benefit from Morpho, or how as a retail they could benefit from Morpho?
Yeah, I think for those who have come from TradFi, probably realize Morpho's potential way earlier than, like DeFi natives. And it's because in the real world, in TradFi, you have so many different investment products as options, right? Depending on your risk tolerance. So you go to a wealth manager and you say, hey, I've got, say, like $1 million. You want to manage it for me. Like the first question they would ask, or, set of questions they would ask is like, what is your risk tolerance? And, risk tolerance can differ by which like stage in your life cycle you are. If you're 20s, you're, max degen. But if you're like retired, you want to, temper your risk down to like a preservation level, right? So in a monolithic lending protocol, which can be in a sense seen as an investment product, like a fixed income product from the perspective of the lenders, you have no way to express that risk level as a depositor. Everything is, done for you. There are some convenient sides to this model, which is, you don't have to pick, but it's still like a one size fits all solution. Morpho was really interesting because they were successful at onboarding these risk curators who are curating different levels of risk on behalf of the depositors. And of course, there's the prime vaults, which are very tried and tested models that deposits go to borrowers on the other side who have Bitcoin and Ethereum as collateral. But there's various different collateral types that can be included in a vault by a risk curator. And for each collateral type, there's a corresponding risk level and therefore, a rate that a borrower pays. And the different combinations of these different collateral markets can decide what, a lender would be very comfortable depositing into. So I think maybe the fact that I was in TradFi and the concept of diversified risk offerings was very familiar to me. But as soon as the team came out with this concept, I think, yeah, like it was kind of a no-brainer for a lot of the the Steakhouse members as well, many of whom are actually from TradFi. So I think that was very instrumental in making the team decide to be the first ever risk curator on Morpho.
Yeah, so since you mentioned about risk curation, one thing that comes into my mind is that DeFi liquidation happens in seconds. So if a loan needs to be liquidated, it happens in seconds. However, if it's an RWA, either it's a delta neutral fund, either it's a private credit, it settles in T+1, T+n, right? So how do you solve the temporal friction over
Yeah,
here?
so that's a really good question. Another way of putting it is that liquidations for RWAs are no longer an arbitrage trade, but it's a fixed income trade. So, for Bitcoin or ETH collateral, as a liquidator, you seize the collateral and can sell it immediately in the market. So you collect the liquidation premium from a lending market like Morpho, and you don't incur any market exposure to the underlying. As you say, Tiffany, for T+1 or longer duration vehicles, the liquidator has to understand what it is that he or she is seizing. So it becomes an exercise of more like credit risk underwriting for the asset that they have, such that, if they can redeem in the next day with the primary issuer, then they have to be comfortable with like 1 day's worth of NAV risk. So I think it naturally restricts the liquidations to just anyone, to mostly institutional players or sophisticated investors who understand the product and have the wherewithal to onboard as a professional investor to some of these products.
Yeah, I think this is especially very important since there has been several incidents in traditional finance where liquidity and private credit redemption are being mismatched and cause several financial stocks. Another question that comes up here is for the RWAs that the liquidator might be redeeming. How do you ensure the legality? I believe this is widely discussed because it's not just for private credit, it's also for whatever secondary stock trading products that we have on chain or even pre-IPO products. So how do you think about that? I believe there has been a lot of conversation between you guys and lawyers.
First things first is that only onboarded individuals and institutions with the asset issuer can liquidate the asset. So it's not like liquidations are done on Morpho for 3F collateral, but the permissions are only granted to people who are already onboarded with the asset issuer. For our first asset is JAAA by Centrifuge. To be a liquidator on the 3F market, you have to be onboarded with Centrifuge. And there's like KYC and AML checks that the asset issuers undertake. So that's why I said it shrinks the pool of potential liquidators naturally. In terms of the transferability, so even if you're onboarded, when you seize the collateral, now the asset issuer has to update their shareholder registry for who owns which units of the asset, right? So I think this is actually something that every tokenization agent or asset issuer does slightly differently. A lot of right now tokenization agents, to my knowledge, have off-chain shareholder registry. So there needs to be some like manual off-chain process whereby, you sign like a transfer agreement from one shareholder to the next if there is a change in ownership. So it's a much less efficient way, but I don't think this will last, the duration of, that life of RWAs on chain. I think this is kind of like a transition period until tokenization agents find a way to make on-chain registry enforceable. So at the time of the share transfer, there doesn't need to be like an off-chain agreement or paperwork that has to be done to make liquidations seamless.
So I believe a lot of the participants and from many different angles would be institutions. First of all, Sonya, could you also walk us through all kinds of participants that are participating in the process of 3F?
Can I share a screen? I think a visual might actually be much easier here. Yeah, so this is the famous money flow diagram that we probably in our fundraising journey explained 100 plus times to investors, but can you see this?
Yes.
Okay. So this is how the 3F protocol works, the money flow under the hood. For an investor or like a depositor into the 3F vaults, you're not going to see any of this. It's all abstracted away from you. So you come to the 3F app as a depositor, and what you literally only have to do is pick the asset that you want to leverage and then pick your leverage factor and then click deposit. And then everything else, this like 1 through 7 will be done for you. But I still want to explain to the viewers what's going on. So in a traditional looping mechanism, you've got this money flow of the user buys an asset to the right-hand corner here, hedge fund or asset manager buys the asset. Once the tokenization agent issues the token, then you collateralize it on Morpho, and then you borrow against it. For a T+1 vehicle, it settles the next day. So then you go again. Next day, you buy the asset, collateralized on Morpho, and then borrow against it. And then you can go through like 20 different loops or 20 days in this case to build up your leverage position. We're not doing any of that because 20 days is way too long. So what we're doing instead is using, this is called prime broker here, but we're actually calling this role BFs, not boyfriends, but bridge facilitators. The bridge facilitators are giving the protocol fully on chain an upfront loan such that an LP, leverage LP who wants to, in this case, 5x leverage with 1 million USDT. We need 4 million of leverage to build this leverage position for the user. So the protocol asks the prime brokers or bridge facilitators for 4 million credit line. And this is done with an RFQ system where these BFs quote their most competitive pricing in an auction. And when the auction closes, from the most competitive offer, it lifts the liquidity such that the 4 million, is taken on chain. And with the 1 million user capital, 5 million can be invested in the underlying RWA. And when the RWA is issued, it's immediately collateralized on Morpho to draw an over-collateralized loan against it. And that loan can be repaid to BFs, making them whole. So for a T+1 asset, the BFs are providing a 1-day loan for which they will be repaid like a fixed yield. So yesterday our auction closed. This was our second ever auction, and the BFs for an overnight facility earned just under 9% APY. So the rate is actually, premium to what you would earn, for instance, depositing simply in the Morpho vaults in an over collateralized lending pool.
So in short, we can say we have like 4 kinds of participants in the protocol, right? First of all is the guys who likes to loop, and now they don't need to loop. They deposit into your vault. You have the lenders, right? And then you have the asset issuers who are issuing RWAs, which will be using your standard to tokenize their assets. And then you have the BFs, the bridge.
Exactly. And then actually the fifth entity is the liquidators. If the LPs here are too levered, then as we discussed, we need someone to step in and provide liquidations.
So I think I want to break it down from how different participants are able to benefit from 3F. So first of all, I believe it's very straightforward for DeFi loopers, right? They don't need to loop anymore. Well, if they want to loop for 20x, they might still need to loop since X is deemed as particularly high risk. So DeFi loopers are benefiting from that. And what about the lenders? How do you see the benefits of 3F from a lender's perspective?
Yeah, so I think what you're touching on here is like what we call the 3F capital stack. So there's 4 different ways that you can earn from 3F. We go from most risky to least risky, since you already brought up the leverage LPs. So leverage LPs, it's the most risky. You can earn double-digit yields choosing your leverage factor. If there's negative carry, then you lose not just a little bit, but amplified by your leverage factor. But, equally on the upside, you can gain. So it's the most volatile way of earning yield. The next on the capital stack is the BFs. So this is actually kind of like unsecured lending, in that, it's not a traditional over collateralized lend, and it's fixed rate. So we're actually bringing fixed rate to the market for institutional whitelisted players. And around, as I said, last auction cleared at 9%. It's slightly higher risk, but it's got, a certain characteristic, which is that actually on the inflow, there is no credit risk, because you're just facilitating this liquidity to buy this new asset at the NAV. The same NAV is used to collateralize on Morpho to pay them back. So there is no credit risk that the prime brokers, or BFs rather, are incurring. On the way out, when the LP asks for the money back, the protocol draws a loan to pay down this Morpho debt. And then when the next day you can turn the RWA into cash, then the BFs are paid back as well as the LPs. So in this money flow, you actually do have 1 day of NAV risk. So, it's a pretty sophisticated instrument that only institutional players are able to really quote for. So this is like a whitelisted role. The safest part of our capital stack is the depositors into the Morpho vault. So this is a typical over collateralized lending. You may get single digit returns, but, there is less risk of bad debt if the risk curator is doing their job right. We've partnered up naturally with Steakhouse, who is risk curating for the 3F vault. So this is a typical solution that would be very suitable for, say, DeFi mullet integrations for exchanges, where the stablecoin holder doesn't want to take too much risk, but they want to earn some steady, safe, dependable yield. So they would be lending against the loopers on the other side who are borrowing to lever up. So those three things are kind of the main earning opportunities at 3F.
So what I want to bring up here is the whole stack. I think who's the ones that's going to benefit from it the most is the loopers that are in DeFi. And if we look at the current RWA landscape, I think there's like over 750 mil of RWA collateral on Morpho itself. And if you look overall on chain, it's even more. But currently, it's been institutions buying and holding, and not a lot of transactions has been made from that. Not a lot of liquidity has been made from that. So how does 3F's appearance impact or change this dynamics?
So we've tried to minimize, the yield opportunity is there for leverage carry with RWA products, right? But as I mentioned, there's so many friction points that have really been hard for an average Joe to be able to do this. So we've thought through what are the biggest hurdles, pain points, and friction points for gaining exposure to the leverage carry trade using RWAs, and how can we minimize these friction points? And that was our starting point for 3F. There's two considerations. One right now is like the minimum size is too high for a lot of these institutional products. If you only want to loop, say with 1K capital, you should be able to do that. Instead of having to put in minimum size of like 100K. So having a platform that enables access, where, we're kind of aggregating all this liquidity from all these loopers, that gives us buying power and size. That also means, we can subscribe into assets and maybe even get some rebates down the road from asset issuers, because we're operating with size. So that gives economies of scale and better access to people who are investing with small amount of capital. And the second point is looping. We don't want to loop. We want to create this mechanism where we can, with one settlement cycle, build up the position and wind it down. This works because of our BFs. But if you were retail, who would, in their right mind, would, as an institution, give an unsecured credit line to a single, person who wants to loop with 1K? That doesn't happen. So by building a protocol where there is no counterparty risk, because the flows are done all on chain transparently, these prime brokers or market makers or protocols with balance sheet power, they can participate as our BF, and they're happy to provide funding because they don't have counterparty against myself or my co-founder Romeo or any of the individual 3F leverage LPs. They just have to trust that the smart contracts are transferring the money from their wallet to the destination, which is the asset issuer, because, the smart contracts have been tested with our security auditors, and you can actually see the money flow. They can be comfortable fronting us the upfront capital, and, we can minimize the frictions of looping with this mechanism.
Yeah, I think the best way or the easiest way for retail audiences to understand this is previously a lot of companies lent money to Three Arrows, and Three Arrows could spend their money into an unlimited kind of trades or products. And now when these companies lend you money, it's only designated into the vault that 3F is directing it into. So this is the first time that any random retail would be able to get a credit line, even with just one case of size. So that also enables retailers to participate in a lot of RWAs that actually has a minimum size. Since you mentioned about those RWA users that could be a part of the stack. How would you rate an RWA, and what's the most exciting RWA that you're seeing in the industry? And of course, in the past months, we have been seeing some successful TGEs of certain RWAs, right? Including stablecoins ones, non-stablecoin ones. We're not going to mention about the real name here, but I believe you know what I'm saying. So how would you rate the RWAs, and let our audiences know how should they consider them in terms of risk-wise and also from a asset premium perspective?
Yeah. So at 3F, like the ultimate goal is to just be a very neutral, unopinionated infrastructure where any asset can be leveraged. If you go on, Hyperliquid, for instance, and you want exposure to perps, Hyperliquid doesn't like instruct you, this is a good asset, this is a bad asset. It just provides the users the opportunity to express their views. So very similarly, our vision is to bring on as many RWAs as possible. Of course, the carry trade only really works if there's, good yield. And that means right now treasuries can't really work because in the last couple of weeks, borrow costs have gone up. So there isn't much spread to take advantage of. But we can start with, like CLO funds, or increasingly asset issuers are pushing high yield funds with still low volatility, but slightly higher returns, say like 6 to 7%. And that gives us juicy spreads to be able to lever up. So we're right now doing a lot of due diligence on these higher yielding funds for users who want bigger spreads to take advantage of. But of course, yeah, as I mentioned, we want all sorts of assets in the long term for people to come to our front end and be able to express their views on the underlying assets.
So does this mean that for whatever RWA asset issuers, if they are interested in gaining liquidity from this looping infrastructure, they should contact you? Do you have a preferred asset kind right now for collaboration? Just feel free to.
A personal preference of mine is we've had one too many exploits and hacks for assets that are issued natively on chain. And it's a function of two things. Like one, in the case of like stream finance, there's just like really bad underwriting, and, I don't know who was actually trading on behalf of, stream finance, but it was poor risk management. But then the other side is also OPSEC and security. In the case of Resolve, somebody got the private keys and pressed the mint button, and you just had like this millions of unbacked coins that were minted. In both cases, I think it highlights that a lot of the crypto native assets are much riskier for now than the RWAs that are being tokenized and coming on chain. So I am very much looking forward to picking the best parts of TradFi, which is like professional underwriting. You've got like CFAs and like people who are experts in their specific domain, bringing this return and yield through a rigorous underwriting process and bringing it on chain. And also then, exploring new use cases of how this ported over yield can be used in a creative way through DeFi platforms such as 3F. I think that intersection is so important and exciting for me. So, this is a call out to all the asset managers who have professional underwriting standards. Tokenize your funds with us, or not with us, but with your tokenization agent of choice, and we can be your distribution partner, because on-chain capital still wants to transform these single-digit returns to double-digit through leverage. And I believe that 3F is the best platform to be able to do that.
Yeah, so let's say in the future, 3F would be distributing all kinds of RWAs to users on behalf of these asset issuers. How would this change the yield environment across lending, especially when we are seeing a very low yield across Aave and Morpho?
To deliver more steady borrower demand. So 3F aggregates borrower demand. We discuss, where does borrower demand come from? First, the whales who are looking for buying a house, then the traders who are yield farming. Leverage carry trade is not dependent on crypto market cycles. As long as there's the spread, whether it be bear market, whether it be bull market, there should be some asset that's leverageable from the leverage carry trade. So right now, I believe for JAAA is earning, 450 basis points or so. You can borrow against it on Morpho at 325 basis points. So you've got 125 basis point to be able to lever up. This is happening in the bear market. But in the bull market, maybe there's some other asset that we bring on board where the borrow cost goes up, but so does the yield on the product that you're leveraging. Crypto carry funds are a really good example of this, like Superstate USDC, for instance. It goes up when the crypto market's going up. It goes down when the crypto market's going down. So we're going to be also introducing assets like this, where in the bull market, people still have borrow demand because you can lever up the positive spread. So if we have, borrow demand in the bear market, borrow demand in the bull market, the lending rates will be much more steady than what we have seen historically, which is, if there's no farming opportunity, then there's no leverage demand, and then the yields crater on lending protocols.
And so since you mentioned about the bear and bull in crypto, because that makes a lot of difference. In the past, RWA only gets mentioned when the market is very bearish. I understand that now you get the opportunity to loop up the yield, but of course there will still be a lot of yield or farming opportunities in DeFi when the bull market is here and people will be farming for the potential token surge, right? So how would RWA-backed yield product look like during the crypto bull? Would that still be attractive when there are a lot of more degen protocols around?
That's a really good and fair question. I think when we say RWA, we use the term quite loosely as well. So for instance, there are RWAs that are leveraged to crypto market cycles. The Superstate, USDC fund is one. Another one is the FalconX private credit vault. So this vault is, I believe, issued by Pareto. Depositors into this FalconX private credit vault on Pareto are extending basically a loan through FalconX to their clients. So FalconX can charge a higher rate when there is, vibrant crypto market. And then the yields naturally sag a little bit in the bear market when there's not that much bar demand. So there are RWAs that will go up and down with the crypto markets as well. And I think that in the mega crypto bull market, these instruments will end up becoming more popular. One other thing I want to say is I think the days of crazy yield farming are behind us. A lot of projects who stupidly incentivize with their token have realized that you've issued a lot of token, but the TVL is very fleeting once you stop incentivizing. So, the equity terminology for this is you've just issued a lot of shares for customer acquisition that didn't pan out. And actually, as a DeFi protocol founder myself, we don't want to do, if possible, any incentives because we've found out that there's a lot of mercenary capital that's chasing incentives. And then once the token is launched and unlocked, you just move to the next opportunity and take your capital with you. I think the industry as a whole is learning this lesson. And if I had to predict the next 5 years, we see less and less token farming opportunities than we have seen in the last 5 years, which should, in theory, stabilize the borrow rates anyway.
I do agree with you that a lot of old users are learning that lesson. But I believe in the next cycle, there will still be new users getting attracted by the next wave of very degen opportunities. Because if you're not degen, you will not be in this thing. I love the idea that with 3F, more and more RWA can be distributed to even retails, right? So let's imagine a future where all those actual real world assets are being cleared on chain. What are the missing parts that we need for DeFi to become the actual clearinghouse for RWA or global credit market?
I think right now, going back to where we started, is DeFi dead? I think the industry needs to have more robust infrastructure, and that doesn't mean just smart contracts. I think we actually got pretty good at building good smart contracts thanks to the security auditors and, just more time passes, more bugs are discovered and fixed. So there's a natural learning curve there. But now what we're seeing is OPSEC, especially from smaller teams like crypto teams, need to be much, much better to usher in trillions of dollars of, global assets on chain. And I think we have a lot to learn from TradFi in this regard. So I was actually speaking to someone from Fidelity Digital Assets team the other day, and they've been building their crypto custody solution for a really, really long time. I believe since like 2016. And I asked so who's got the keys, and, how do you guys do custody right? And basically it's so well done that not one person in the organization has complete, information to be able to piece together how the security is done. So I think we have a lot to learn as well from the latecomers into crypto and from TradFi specifically, and understand what they do to meet these crazy operational compliance hurdles, because their first and foremost focus being in this financial services market for a really long time is securing funds for users and customers. So I want to take that away from TradFi and bring that kind of same ethos to the way we operate as DeFi founders.
So I think that definitely means something, especially for the team to make sure no actual one person can take away the axe.
Yeah, I highly encourage all teams to do OPSEC audit. So that consists of getting new devices that are specifically dedicated to just your professional work. And maybe we had too much of it in crypto in the early stages, because building this global permissionless financial market was very exciting. But now we need to be very vigilant about who we're speaking to, who we're relaying information to. So in real life meetings, I think will matter a lot more in crypto going forward.
Yeah, actually, I actually would like to echo on this, because I used to invest in cybersecurity technologies, and most of the hacks comes from social engineering. So that means by sending you a hello, or if you're on Telegram, I think the most frequently seen one is, oh, long time no see, do you want to have a catch up? And then this person sends over a Calendly link, which is fake, and once you click into it and hop on the call, they will ask you to download some kind of malwares, and that's how you lose all your assets, right? Even have the risk of losing your whole Telegram account. So I definitely agree with you on that. That kind of training is very important. Since we are coming to the last but not least of the podcast, I think we do have some questions that I believe a lot of retail investors would be very interested in. Imagine the future that 3F Labs has a lot of RWAs that you're supporting with. What would be one product that you as a DeFi investor would deploy into?
Oh, is that a roundabout way of asking how degen I am or not? I think if you're going to apply leverage, you definitely want to apply leverage to more dependable assets that are not going to be too volatile and potentially liquidate you. Or, you buy a more volatile asset and apply smaller leverage. It's generally, I think, a bad idea to, get a very volatile asset and then leverage it like 20, 30 times. We started the protocol with one of the most dependable assets, or in our view, one of the most dependable assets that's also gained good amount of TVL. And that was Centrifuge's Janus Henderson, AAA CLO. So to get into this a little bit more, AAA CLOs have never seen credit defaults, even through, the financial crisis. So yeah, AAA CLOs, while they have no effective duration, have some spread duration. So that means if there's a war or global financial crisis again, and people are very freaked out, then the risk tolerance of the investors could mean that the fund experiences volatility from time to time. But the underlying loans themselves have fared really well through different environments. We like the credit profile of this, or I personally like the credit profile of this fund. Janus Henderson, has an ETF out of this fund, which is over, I believe, 25 billion in TradFi. So it's a really popular fund that in many cases people almost like synonymize with treasuries, except, instead of treasuries, you're gaining like a little bit more yield. The reason why we chose this asset as like our first testing asset was because of its really good credit profile and yield profile, especially in this bear market. And so yeah, I encourage the viewers to test it out. We're live with private beta, so if you like to test out the leverage vaults, then find me on Telegram or find me on my Twitter. Slide into our DMs.
And just to echo that, I think if you're interested in RWA or interested in DeFi lending, you should definitely check out Sonya's Twitter, because that's how I found her, from one of her very insightful
Thank you.
articles.
Yeah, we try to. There's a lot of like
And
complex mechanisms, and I used to like tutor a lot in college. I was a math major, and I tutored math to like music majors at NYU. So I love breaking the complex concepts down into simple, more digestible pieces. So yeah, I'll continue to shed more light on understandable ways of explaining 3F and just a general lending and DeFi landscape too.
yeah, also, following up on that, being an expert in DeFi lending and especially RWA lending, what is one brutal truth about RWA lending that no one is talking about right now?
I think RWA lending as a whole is a very nascent part of DeFi lending. So all the DeFi integrations right now with like centralized exchanges, these are all crypto-backed loans, crypto-backed lending. And it's taken us a few years to really gain confidence in this automated liquidation process on lending protocols and making sure that, like there isn't much bad debt realized on the side of the lenders. But right now, what we're seeing is this is still very early for RWA collateral. So I want to, pioneer scaling this kind of lending for DeFi through, connections and strategic partnerships with many more centralized exchanges, for instance. And yeah, I guess this is where we can talk about, like our partnership with Gate Ventures or Gate ecosystem overall in the future.
Well, I'm super looking forward to this, since it's going to give us a more stable, a more dependable. I also want to ask, so looking at the long-term roadmap, how would you consider the distinction between TradFi and DeFi?
Oh, that's a really good question. I think they're merging, but I don't know if they will reside, two separate corners or if they'll just become one. I see even in traditional asset management companies, like the crypto people are like a little bit younger and cooler. And the traditional part of the business is like a little bit sleepier and, silver haired. Um, I wonder if, as we get older and crypto as an industry gets older, if that just kind of completely collapses and the whole thing becomes the same thing, or if, the fun people who are more experimental will always want to be in this like more innovative side of even the large asset managers who are getting into crypto. So I'm not sure, but the truth is the two worlds are definitely blending. And I think this is what is required for our industry to not be like a science project, but to actually make a big impact in the world of traditional finance. But I will always miss this, this kind of defiant culture that crypto had always had. And this, I've met some of the most stimulating, thoughtful people working in DeFi versus the 10 plus years that I spent in TradFi.
Well, I think this is definitely a very fun place to be at. But at the same time, you need to have a strong heart to ride the roller coaster. But for those who have been through like maybe the FTX collapse, Luna collapse, I think we've all survived. And best investment comes out from bear market. That's one thing that I learned bear market is the best timing to find
So you're
alpha.
very hopeful about 3F. Let's go.
I am very hopeful. Just to also highlight this to our audiences, I understand that it's a very cold market for projects to fundraise from venture capitals. But we are still deploying. So we still have a very high standard. So it's been very difficult for us to deploy. So whenever we deploy, we're very bullish and seriously bullish about something.
And as a recent Porco, I can vouch for this. Being based in North America, I was frankly very US focused in my search for VCs. But when we went out to Asia and I met Kevin and Tiffany in Hong Kong, and actually IRL meetings are very, very helpful in learning more about teams from halfway across the world. So I strongly recommend that founders who want to raise, go meet with the VC teams, and it'll give you an entirely different, picture of the team quality. And yeah, in our discussions, I was very pleased that we connected and you guys were very thoughtful and asking all the really nuanced questions, which honestly, we were very impressed by your team. So we're very grateful for your support and looking forward to building out the 3F ecosystem along with the Gate ecosystem.
Yeah, love that. For now, I think it's very important for VCs to be on the same boat with the projects and provide actual help so that we can all survive the bear. And also speaking about as a founder, since TradFi is also getting into crypto, a lot of sectors are kind of being dominated by TradFi. So where do you see the opportunities for an individual founder, just to avoid competition with actual big whales?
I don't think you can avoid competition, but you can use them to scale up your business. So I must say, we're talking about institutions coming. Institutions are coming, but they're coming slowly because they have these really high operational and compliance hurdles that they have to clear. So even between stating the intention that, TradFi will do something and then delivering an actual product, the lead time can be very, very big. So my advice would be to grow with the DeFi projects, compose with like-minded protocols, and keep innovating with partners in DeFi. And once you find product market fit, then TradFi can be a really good way to scale up your product. I think this is what, my short time at Steakhouse, we built a product and scaled it in 2 years. The Coinbase Earn integration was very pivotal. I mean, maybe Coinbase isn't your traditional TradFi, but it's still a big institution with great distribution power. But for the first year, we just ideated with the Morpho team, which was also at the time very young, ambitious and very competent, but very DeFi native. So I think we can all bond together and try and make something cool in DeFi. And then once it has product market fit, use TradFi to scale and become big.
Yeah, I agree with you. This is the best timing to bond with an ecosystem and scale upon the platform. I think crypto has come to the point that pretty much we have all kinds of ecosystems. And for now, the most promising way out is to scale or stand on the shoulder of a giant. So I definitely agree with you. If you are a founder, if you are looking for ideas to work on, I think this is a very good advice that Sonya gave. For our last question, as a DeFi native, DeFi OG, what would be the ultimate form of DeFi? Would DeFi be the savior of legacy banks? They will start using DeFi for their settlement or transactions? Or is it going to be destroying geographic monopoly on wealth? So for those who are bankless, they can also reap the fruit of that.
Yeah, I think all of it is true. So we're going to probably help make the existing efficiencies much greater on the back end, settlement much faster through blockchains, increase accessibility. But what really speaks to me is using the programmability and transparency of smart contracts and blockchains to create new primitives that were not possible before to automate or even bring it to a greater set of people in the world. So this, I think, fits. This description is what 3F is trying to bring. Traditional hedge funds do leverage carry trades for a really, really long time, but that requires you to have access to capital. And retail just, it's not possible to do like a leverage carry trade as a retail person. It's very difficult because of the lack of access to capital. And this is actually what, for instance, like someone like Athena did really well. They took something that is only available to institutions or hedge funds, like the basis trade. And then they were able to bring this to the masses through the USDE mechanism. I'm really inspired by the ability for blockchains to enable access to people who previously would not have had access to the basis trade or the leverage carry trade. So using blockchains, achieving greater distribution is something that I'm really passionate about.
We have come to the end of our podcast, and thank you, Sonya, for being with us. I know it's been a long journey for this podcast, and really thank you for hopping on this at such a early morning. So if any of the audiences, if you are interested in working with 3F, please feel free to ping Sonya or just ping me. I can make intro. Or if you have any ideas that you'd like to discuss, feel free to ping me anytime. We're always online and very passionate about innovating in this space. And Sonya, do you have any words?
Maybe worth saying that my Twitter is Sonya Sun Kim. So yeah, if you want to, test out our private beta, or if you're an institution who want to be our BF, or if you're, an asset manager with tokenization roadmap for interesting assets that you want to distribute through 3F, in all those cases, feel free to reach out to me on Twitter.
Hey, thank you, Sonya.
Thanks.
Thank you. Have a nice
Thanks, Tiffany.
day.
Good night.